We have retail completely crashing. We know there's a lot of stores closing. A lot of people are losing their jobs. But the corporate media, the government, the Fed, they're continually pushing out statistics that everything is A-OK. And when you see stores closing down in malls, in strip malls, you scratch your head and you say, what's going on here? And there's many different ways where they can manipulate all this. I mean, if we go back in time where the United States decided to give cash for clunkers, they were trying to boost the automobile industry. Now, this was to create the illusion that things were going well, to get people to purchase cars. And we see Europe, they're doing the same exact thing. Now, Volkswagen, the German car brand, announced it will be paying up to 10,000 euros per your old car of any brand if you trade it in for a brand new Volkswagen in Germany. And then just a few days later, Opel, which is previously owned by General Motors, but now owned by PSA, the French brand, they're doing the same exact thing. And they're offering around 7,000 euros if they trade in their old car. Doesn't matter if it's an Opel or not. Doesn't matter what the brand is, as long as you buy a new Opel. So they're doing the same type of incentive program that the U.S. did, which was called Cash for Clunkers. And they're trying to boost car sales to save the failing car industry. Because what we're seeing right now is that the automobile industry, they're having a very tough time. Now, of course, does this really save the industry? No, it gives it a little bump up for a little time being, and then everything completely falls apart afterwards. And there's other ways they can manipulate the numbers. Just like here in the United States, they like to channel stuff. Remember, every time they bring a car onto the lot, it's considered a sale. It's not when they sell the car, it's when they bring it onto the lot. So they can make the numbers look fantastic. Enron used to do incredible accounting tricks where they made everything look fantastic, and look what happened to them. Bernie Madoff, he had a whole Ponzi scheme going. People thought they were making tons of money, but look what happened to him. All of these schemes always come to an end. Now, what's very interesting, the corporate media, the government, they came out and they're telling you how great U.S. retail sales are in July. They're just fantastic. Everything rebounded and everything is going smoothly and very, very well. Now, remember, we've had declining 2 straight months of U.S. retail sales. And then all of a sudden, they're talking about this 0.6% month-on-month gain. Now, this is the most since December of 2016. But this was driven by a surge in motor vehicles. Because remember, the car companies are trying to move the cars on the lots because they channel stuffed all the lots. And what they're doing is they're giving huge incentives. Cash back, 0%, lowering the prices. Now, they did this prior to 2008, and the car industry got into trouble. They're doing the same thing right now. We also have to look at the retail sales, and they have been revised away magically, and all of a sudden we see for the last couple of months where retail sales have been improving. Now, we need to remember that a lot of stores, they already started to close. There's a lot more that will be closing, and we need to understand how they calculate retail sales. Remember, this is an estimate. This isn't the actual numbers that the retailers put out. And from all these retailers that are closing, what the government likes to do is they like to take all the declining sales and they like to spread it out over many, many months. So if you have 10 stores closing and the stores just come to a screeching halt and the sales just come to a screeching halt, they don't say, okay, sales are way down. They take those numbers out, they massage them, and bring them out over many, many months. So what we're seeing right now is this manipulation of retail sales to make everyone believe that retail is doing much, much better than it is. Now, everything rose except for clothing stores. They're down by negative 0.2%. Electronics and appliance stores, they're down by negative 0.5%. And gasoline stations, they're down by negative 0.4%. Now, what's very interesting, a research company called South Bay Research, they're looking at the numbers and they're saying something just doesn't sound right. Because remember, just like 2 weeks ago, the auto industry, their sales were absolutely awful. Think about it. GM, they were down 15% year on year. Ford was off by 7%. Chrysler down by 11%. Now, according to the retail sales report from the Census Bureau, sales for motor vehicles and parts stores rose much more robustly than anyone had anticipated, rising 1.2%, the fastest pace since December. Now, these numbers are kind of strange and very bizarre because they're completely out of context with recent sales data. And South Bay Research, well, they looked at the numbers and they said this doesn't even make sense. And when you look at it, it really doesn't. Think about it. Consumer retail spending was actually mild. It didn't improve. And they're wondering, where did these numbers come from? And they're saying, don't believe the auto sales data per the BEA. Unit sales were completely flat. So there's no rise in auto sales per the real world and the BEA, coupled with a fall in net prices. But in the fantasy land of the Census Bureau, they're making it seem like everything is fine. Now, South Bay, they have this index called the Vice Index. And for those who are unfamiliar with the Vice Index, it tracks U.S. consumer spending on alcohol, marijuana, prostitution, gambling. Vices are a special form of discretionary spending that is highly sensitive to near-term economic conditions. 1, it's cash-based, depends on free cash flow. 2, luxury spending, wants, not needs. 3, significant dollar amount, not pricey, but not cheap. Vice spending is broadly representative of the U.S. consumer. And the reason why this index is of particular interest is because vices predict retail spending with a 4-month lead. Luxury spending is the first thing to be affected by changes in household finances. And when you look at the index is down around -2%, which shows that people aren't going out and they're not purchasing. So these numbers that the Census Bureau is putting out is once again fake, phony, and false. They're not backed up by any type of reality. These are estimates, and they're trying to make it look like, because this is what they expected to happen, they wanted everyone to believe that the retail industry was doing well. But we can see from Dick's Sporting Stores, well, they're not doing that well at all. Now, Dick's stocks, they crashed after reporting dreadful results this morning. Their both comp sales and EPS, they missed as the company slashed its full-year guidance below even the lowest sell-side forecast. And the CEO was out there, and the CEO, Ed Stack, he's saying that they looked at the consumer market, and the consumers have told them that their prices are not competitive in today's environment, and they need to lower the prices. Now, what they're going to have to do is they're going to have to give deep discounts, and this is what they started to do. But we can see right now that people aren't running out and purchasing. People are looking for deals. Why? Because they don't have the funds to pay for these expensive items. They rather go shopping, and they rather find deals when they need to purchase something. So the time of the expensive stores where they're charging the high prices, that is coming to an end, because as more and more people lose jobs, more and more people making less jobs, as wages continually fall, guess what happens? People look at Dick's, they look at maybe Amazon, they look at other retailers and say, you know something? I don't need to spend that much there. I can spend it someplace else. And this is what's happening. And these stores are going to get hurt because their entire model is built on the cost structure of having these items at a certain price level. And once they start reducing it, guess what? They lose profit. And we can see this is happening across the entire United States with the retail sector. Even with online, because just because it's online doesn't mean it's cheap. I mean, I've gone to Amazon before and I found a product, and I've gone to a store, a brick and mortar store, and I found that Amazon was more expensive than the brick and mortar store. So these retailers today, all of them, even online, they're going to have to change, because the spending habits of people, that is changing. Now, what's very interesting is that the Fed, now we've talked about this before, there's one thing the Fed can't make people do. That is spend money. Now, they can make people take loans out. Well, you have to go to college. College is too expensive. Take a loan out. You want to purchase a house? Well, take a loan out, because you can definitely not, you're not going to be putting down 3, 4, 5, 6, 7, 8, 9, $1 million on a house. It's just not going to happen. Most of the people don't have that type of cash. If you're going to go purchase a car, you're not going to shell out $20, $30, $40, $50,000 for a new car. So you're not, most likely you're not even going to finance it. Most people are leasing today because it's just too expensive. The incomes, the wages have not kept up with the inflation on automobiles, on houses, on college tuition. And that's where we are seeing inflation. Now, what's very interesting is that the housing bubble right now, well, it has started again. Now, I'm going to bring this all into what the Fed wants everyone to do. Now, there's a lot of people that are purchasing homes with less than 10% down. So what they're looking at right now, and this is coming from Black Knight Financial Services, they're pointing out that down payments, the very thing that is supposed to deter rampant housing speculation, well, it's now much easier for people to go purchase a house, because what they're seeing is about 1.5 million borrowers have purchased a home with less than 10% down. This is a 7-year high. And with housing prices continually moving up, people think, wow, I put less than 10% down. I bought my house at $200,000 and now it's worth $225,000 because the Fed has been blowing up the bubble. Why have they been doing this? Because what they want people to do is they want them to feel good about their purchase. They want people to say, you know something, I'm doing well. I have my job and I have my home, and my home is going up in price. That's what they're trying to do. And when people feel good and they see their house, appreciating, it makes them feel confident. Now the Fed wants people to take that money out of the house. Fed Dudley, well, he is saying that, listen, we need everyone to tap their home equity right now. Real estate has gone up. We don't think it's coming down. And you've made quite a bit of money on your homes. It is now time to tap into the home equity and go out and purchase goods. Now, we saw this once before. This was in 2008. And a lot of people, because of the appreciation in their homes, they felt very comfortable where they went and they took a home equity line of credit. They took that money, they bought a car, they bought any other type of product, a high ticket item product, because they were able to take the home equity line out of their house and they were able to use this someplace else. And what happened later on, well, everything was a complete disaster. So basically what he's saying is that your house, once again, is an ATM, and now is the time to do it. Why is he saying it right now? Because he knows that there's only a small window, because the housing market is not doing well. And he knows that prices are starting to fall. And he wants people to go out and to spend to keep the system operational. And this is what the central bankers do. Think about what they've been doing, because they're becoming so desperate that they need to do all these things. They need to offer 0% interest. They need to tell you to take your home equity line and go spend in retail. They're doing all of these things because this is the end game right here. They have nothing else to do. And the only way they can get people to spend is to give them funds. And if you tell people, listen, 0% interest, go out and get a home equity line of credit, go out and spend, your house is just going to go up in value, everything's going to be great, most people will say, oh, okay, that sounds great. Now, what's very interesting about all of this is that the Fed also issued a warning that household debt has hit an all-time new high, where they're saying that the U.S. credit card debt, it's above where it was in 2008. So on one side of the mouth of the Fed, they're telling us that, hey, listen, it's a great time to take out another loan. On the other side, they're issuing a warning that U.S. credit card debt is at an all-time high. And this is very concerning to the Fed because they don't believe that this debt level can be sustained. Well, as we can see, back in 2008, it couldn't be sustained. It was a complete disaster. So this is what it looks like at the end stage of their fiat system. They're flip-flopping back and forth. They're just trying to get everyone to spend funds, to take out more loans, then warning them that we might have a problem. But of course, they keep that part very, very quiet. And we can see right now that we are headed toward a complete and utter disaster. The indicators that we have been looking at, they're all pointing to the same thing. And a lot of them are 10 times worse than 2008. And we have to remember, these numbers that we're looking at, they're manipulated, they're massaged, they're fake. Just like the AAA rating on the subprime securities back in 2006, 2007, 2008. It was fake. It was an illusion to draw people in. We're seeing the same thing once again. And they manipulated the entire economy this time. And they're drawing as many people in as they possibly can, and it's going to end in a disaster. This is why you need to be ready and prepared, because sooner or later, the illusion always ends. It always does. People can say it's not going to until it does, and then people just, scurry away, and you never hear from those people again. And everyone who listened to those people are sitting there going, oh, I should have prepared. Because all those times before, 2001, 2008, nothing was fixed. The can was kicked down the street. They created a lot more currency. They made everything worse by pretending everything was better, by manipulating the entire economy. And here we sit today. And from everything that we're looking at, from all the different indicators, it's all coming together. It's almost like a perfect storm, where all these things are coming together, and eventually the Fed will not be able to stop it. The economy will start to deteriorate. It will start to crash.